A major fallacy that I know at one time had me duped. It's marketed with every major institution, and that is the average rate of return, which is just the wrong metric. You always get this beautiful chart, and it's a perfect parabolic chart, and it just shows this constant perfect compounding that's going to just put you up, but it never has a single negative year in it when you use the average.
You only get one shot at this. If you hit that age that you were planning on walking away from your current job and your pile of money is not where it needs to be, you're going back to work for a long, long time.
This is our castle of wealth and the way we're deciding to build wealth, and we haven't properly protected ourselves.
But actual usage here, they make this faulty assumption that past performance equals future returns. If it can't accurately predict the past when we have a perfect selection of data, how can you possibly use that in any meaningful way for your financial planning into the future?
What time period and what events in life happened, where those downward pressures are, is going to create even more eroding factors and make this fallacy more prevalent, more obvious. Hey Hans, here we are for another episode with Remnant Finance. We decided we could fake like we're just talking, but we did that on the last one, and we're actually recording multiple episodes in the same day. So if you see the same clothes, we don't wear the same thing every day. We just record multiple episodes in one sitting sometimes.
Yeah.
Today we're going to talk about a major fallacy that I know at one time had me duped. It's marketed out there by just about every talking head. It's marketed with every major institution, with everybody who pitches market and only investments. And that is the average rate of return, which is just the wrong metric. And we're going to demonstrate why and what that means.
When you realize you've been duped, it stings. And it's something that I've myself have pushed many times in convincing people to go with the standard model. But once you see it, you can't unsee it. The average rate of return is basic math. How can it be a fallacy? Why do we call it the average rate of return fallacy?
I remember the first time I saw this, it was one of my first mentors, and my good friend Mike Everett would talk about this in webinars he would do. And he would use a simple example, I think, that's gone around in our community, but it really illustrates it well. And it's if you think about putting some money in the market, I'm going to stick with Dave Ramsey because I feel like he's the biggest voice out there that people listen to. And I don't mean to pick on him, but he consistently for decades now has talked about a 12% average rate of return. If I look at it, the right year span, there's actually some truth to that. There is a 12% average rate of return in the right market and the right stocks and the right funds. So what he says is actually it's technically not incorrect. I can find that average if I look at the starting number, the end number, and do some averages, and there's a little bit of truth, but there's more to the story than just that basic math. Basic math is not financial math, and math is not money. All those things are true.
Yeah, it's not technically incorrect. It is practically useless. It's extremely misleading. And overall, it's about as effective as a COVID shot.
So it doesn't work?
It does not work at all. In fact, it leaves you much worse off than if you had not applied it.
Yeah, it does some damage to what your expectations are as well. Let's actually talk about like what really goes on when it comes to average rate of return. Let's do the simple example that I first learned. I think it's the first example that I talked to you when we initially started talking about IBC, and it's the one I learned from that mentor of mine, Mike. Is, if you have $100 and you get a 100% rate of return, how much money do you have?
$200.
And then the next year I take your money and I reinvest it as your money manager, and I take a 50% loss. You're kind of mad at me. How much money do you have?
I am back to $100.
Back to $100. And so I want to make this up to you. So I keep working. I say, just stick with me. And I get another 100%. Where are you?
Back to 200.
Yeah. In the fourth and final year, I do a terrible job managing your money again, and I lose 50% again.
We are back to the starting point of $100.
So you're sitting at $100 after 4 years. So I would say to you, you're mad at me, and you're like, dude, I've made absolutely no money with you. Why would I keep working with you? And I say, wait a second. And I do some basic math in the background, and I say 100, up 100, down 50. That leaves me at 50, right? Add another 100% for the third year. I'm at 150. Then I subtract 50 for my next loss. So that's 100% over 4 years. So basic math says I divide 100 by 4, and that would give me the average. I say, Hans, dude, What do you mean you want to leave? I got you an average of 25%.
Right. You'd say, hey, the market goes up, the market goes down. But over this 4-year period, the market returned, or I returned for you, an average rate of return of 25%. But I have $0 to show for it.
You're still sitting on your basis. So that's a drastic example. Nobody sees those kind of swings, but it really illustrates the concept pretty well. I think it really sets it in and says, so if it's false in that broad sense, is it also false in a more realistic example?
Yeah, it is. And when you told me that light bulb clicked, and both things can be true at once, that you can have an average rate of return that accurately reflects a snapshot of market returns, but your actual rate of return could be negative. It could be zero or it could be positive, but it's always going to be less than that average would indicate. And so I started playing with numbers and putting 4 years worth of returns over and over, trying to get closer to market returns. And so I made a scenario where I had an average rate of return of 0%, but actually lost money. Or I had an average rate of return of 8%, which a lot of people talk about being an average market return, and I broke even, or I only gained 4%. So this average rate of return is entirely useless in financial planning. But we're going to get more into, not only is it useless for projecting the future, but it doesn't even accurately reflect the past with perfect data. So we're going to continue to develop this thought process as we go through using some examples, but always kind of come back to let this light bulb moment click for you of it takes a 100% return to make up for a 50% loss. That is objectively true. And that in that little 2-year window, you had a 25% average rate of return. So again, rethink your thinking and be willing to consider that possibly, just be willing to admit that you've been duped, because we have been duped by this line of financial thinking that is almost exclusive to the CFP conventional industry. And I've tried to find any online retirement planner, conventional financial planner that doesn't use this line of thinking, and every single one of them uses the average rate of return to project your gains into the future.
And I love, my favorite thing that I've seen over and over talking to different financial advisors, or even just looking online, is you always get this beautiful chart, and it's a perfect parabolic chart, and it just shows this constant perfect compounding that's going to just put you up, but it never has a single negative year in it when you use the average. It shows growth forever. The cool thing is the product that they typically don't like, that we use in the infinite banking world, actually does go positive forever. Maybe not to the same degree, but it is actual constant compounding. And like I was going to say, like everything else in life, you can really apply this to things that aren't money. There is almost always a larger downward pull when there's something negative introduced. If you think about your credit score, to stay in the money realm, if you have one hiccup, I actually had a hiccup that was a military debt that wasn't paid correctly, and I got it fixed the next day when it hit, but it was a 140 point drop. I had an 800 some score that took years to get to. And it's virtually impossible to have a 140 point swing in the upward. So that one hit just crushed it. If you think about the classroom, I used to be a school teacher. They used to do this absolutely stupid idea of, I remember when I was in school, all the classes were stratified. There was like, there were the kids that were gifted, there were the kids that were kind of above average, there was just the average, or call it gen pop, and then there was like, some kids who were lower performing, and they were all stratified in their classes. And at some point we got this inclusion model, and the idea was that we're going to mix everybody up, and the people who perform better are going to lift everybody up. But it never happened that way, and it doesn't happen that way, and people who think it does are just misguided. When you start bringing in people that are underperforming academically and usually have different behavior, models, let's call it, it brings the entire class down. It brings all the academics down, and we can keep going on and on. And a friend of mine used to say that if you take white gloves and play in the mud doesn't get more glovey, right? There's always, the negative side is always more pronounced. And so that is the problem with this rate of return calculator, is that they exclude the negatives, and it is more pronounced and has a greater effect on your money than the positives over time, or
Yeah.
whenever laid out equally. How about that?
Yeah. So what they do is they'll take a 30-year snapshot and average those numbers. You get that number, and we're going to walk through the actual exact time period from a website on the Dave Ramsey, or an article on the Dave Ramsey website, where they cite these numbers, and we're going to show using historical returns what they projected that money to be based on that average and what the actual return was. And so this plays out in a kind of dangerous way if you make your assumptions based on that. Because remember, most people we're talking to are planning for that. We don't really believe in retirement, but they're planning for that passive income phase where they're working not to continue to accumulate, but they're working at what they do, a life and a job they don't ever want to retire from. But as we're all in that building phase, you only get one shot at this. If you hit that age that you were planning on walking away from your current job and your pile of money is not where it needs to be, you're going back to work for probably for a long, long time. Like, you only get one shot at this. And that beautiful wave, that ever growing mountain of growth that they show, there's a lot of periods in there where that growth is slower, and then it starts hockey sticking upward. But you need that time, those first however many decades of slower growth, to really get to that point that they're showing you where you get this continuous 12% rate of return. And so if I put on my kind of condescending Ramsey talk here, they'll say, the market average is 12% a year, inflation's at 8%, so therefore you can safely spend 4%. That is a scary proposition when the market is objectively not returning 12% every year, even though, yes, that is technically the average. The simple average rate of return, I think we've fairly well kind of debunked how that matters. So what is the actual value that we want to look at when we're evaluating a historical segment of market returns?
Yeah, let me share my screen. I'll show some calculators here. We'll talk through them for those that aren't watching and only listening, but if you're watching, you'll get to see the calculator. I will say before I share that over time, the market has historically gone up. What we're pointing out is that it doesn't perform to the expectations that just about everybody has because of these fallacies. So realistically, you will see an increase in your money over a long period of time, but it's never what is projected in the calculators and in the marketing and advertising.
What he's going to walk through here, the value that matters, think about compounding returns, where you actually have to apply the previous year's return to the entire principal. Because remember, a negative year affects the entire body of principal up to that point. And this compounding return, which we'll call the compounding return versus average rate of return, those are the two comparisons we're making here when Brian walks through this example.
So what I'm going to do is to simplify the example, which we're not going to do any additional payments. It wouldn't turn, it would just be larger numbers if we did. So we're not going to put any more money in the market. Let's just say you had a windfall or you had saved $100,000 by age 35. You want to set it into the market. And I did a large cap from 1990 to 2020. So I tried to get it relatively modern. And we could do to 2023. Doesn't matter. We're going to end up seeing similar things. So you have a $100,000 starting at age 35 and ending at age 65 using the actual data from 1990 to 2020. And that actual data would give us an average rate of return of 11.45%. I will show you where I got that if you're watching in just a moment. I had to go back and put that in. So $100,000 compounded over 30 years at 11.45% ends up giving a balance of 2,585,000 rounded. Now let's look at what actually happened. Here I'm going to click historical rates. So this is going to take large cap stocks. We're going to start that at 1990 for 30 years. And that's where I got the average rate of return. It was actually pulled from that. The actual or the net return compounding is 9.96%. So, and that might not sound like a lot. It's a difference of about 1.5%. But the net result, because it factors in the negative years over that 30-year period, is 1.727 million. And what's that difference, Hans? I know you have it calculated out.
Yeah, that's $857,000 short. Keep in mind that when you're doing this type of financial planning and they're projecting out into the future, it's all based around hitting a number because they calculate how much income do you need each month. You're in a lower tax bracket. You want to retire at this age. We assume you live this long, which again is an assumption that no one can really make. Everything is in our current accumulation phase that most of us are in. In that model, the goal is to hit a magic number that will allow us to live off these returns. And so, like Brian said, $1.7 million is a phenomenal return on 100 grand invested. We're not saying that isn't a great return on your money. However, if your target and what you were told on this average rate of return was just shy of $2.6 million, you are close to $1 million short of that. And so that's a 66% of your actual target projections there, just from the actual market returns in that exact same period.
And the crazy thing is, in those 30 years, there's only 6 down years in the market. 6. So it's not even like we have 15 years that went negative, like in my original, silly example. It's 6. I mean, there's like 10-year spans here where it's all positive, and it still ends up with that kind of difference. So that would lead to quite a different lifestyle, wouldn't it, in retirement?
Yeah, absolutely. And a lot of I can't cite exactly, but a lot of the research from Wade Pfau, who's a PhD who does this exact thing in his research, there are specific days or periods of short as weeks where if you were out of the market for that very short amount of time relative to this 30-year span, that you would have missed out on huge portions of this gain just in a couple days. And so this assumes that you don't have this churn and you stay in the market and you're persistent for 30 years, all of which are assumptions that I don't want to rely on for my one shot at getting the life I want. So yeah, so there's so many variables in here, but even assuming everything goes right, you fall 66% short with perfect hindsight information.
Yeah, and when it comes to that, I actually want to expand on that for just a moment. We talk about the moat around the castle. Well, if this is our castle of wealth and the way we're deciding to build wealth, and we haven't properly protected ourselves through different types of insurance and with a proper saving strategy, any single hiccup in your life, which every one of us is going to experience at some point or another, that is a potential wealth killer, could change this. Because if your money's in the market and you don't have proper protection in place, where are you going to get the money to take care of life's issues? You're probably going to have to pull it out, and you might miss that little window that Hans was just talking about. And I don't know, but that's truth. All of these are fantasy land of nothing changing, right?
Yeah, and this is without any other eroding factors. And so
Yeah.
we had our target, $2.6 million. That's what we were going to get. We fell 34% shy of that, and we are now at 1.7 million with nothing else, no other eroding factors. But what happens if we add an assets under management fee?
Yeah. And let's do extremely conservative here. The average is closer to 2% because there's a lot of embedded management fees beyond just what it shows. But let's just do 0.5% and see what that does. That took it down to 1,486,000. So that 1%, you lost, what's that come out to, about $240,000 and 0.5%.
Yeah, over this 30-year period, they're churning the portfolio, selling a position that incurs a taxable event. There's so many additional factors. This is best case scenario. And so we want to highlight how misleading that average rate of return statistic is. And if you're watching, you can see those numbers in real time with perfect information. It's a pretty powerful illustration of the fallacy and why we don't put any value in the average rate of return.
Yeah. And finally, let's just say you're in a 20% tax bracket and you actually have to pay those taxes from the account. So assuming this isn't a qualified plan, but every year you have to pay 20% if you did this on your own, that changes it to $732,000 at 20%. Pretty wild. If in a non-qualified plan, that might be something that happens. Most people don't pay it from the account, but that means you're paying those taxes from somewhere else.
So you're falling in the ballpark of 25-28% of actual leftover money at the end of this 30-year period of what you were projecting.
Yeah, very different numbers than what's projected on the fancy, colorful charts we see.
So in actual usage here, they make this faulty assumption that past performance equals future returns. Now they'll say on the prospectus, everyone knows, everyone can cite what I'm about to say, which is that past performance do not indicate future returns. That's true, obviously, but when you use that past performance and project that into the future, you're ignoring the inevitable lost years and what that does to your principal. And we, in preparing for this and in trying to validate this concept for myself, as I was initially skeptical, you can take any 30-year window of returns from the market going back to the early 1900s when they started tracking S&P returns. Take any 30-year selection and try to find a selection where your actual compounding returns are anywhere near what the average rate of return would suggest. And you're never going to get anywhere near even 70% of the projected value. And so I'm going to say what I said at the beginning. Even with perfect hindsight, the average rate of return was not at all indicative of what money actually did in the market over that exact same time period with known returns. So if it can't accurately predict the past when we have a perfect selection of data, how can you possibly use that in any meaningful way for your financial planning into the future?
And it's pretty wild. I remember when I was first studying this and 2020 hit, and the last year of data we had was 2019. And I remember running the same thing with I actually just ran it while you were chatting with the large cap stock again, which mimics the S&P. And I said, what if you just did 20 years? There's this common thing about the age I am. I'll be 43 in June this year in 2024. And you hit this like early to mid 40s and you're kind of halfway. You're halfway between when you maybe finished college if you went and when the projected retirement age is. And there's sort of this like look forward, look back period. And a lot of people kind of go into, I don't know if I'll call it crisis mode, but they're like, have I done enough? And I only have the same amount of time going forward. Do I need to do more? So there's a lot of people haven't really saved much at all. If you look at what the average savings rate are in a qualified plan and such, and what the average savings rate is in America, there's a lot of people my age who are virtually broke and they start saving. So imagine doing that and you only have 20 years to go. You started, I'm going to use the historical time because we had two major events here. We had 9/11 and we had the end of the dot-com bubble, and 9/11 happened, and then 2008 with the housing and the market crash there. So they experienced two crashes in that 20 years. That same $100,000, Hans, what do you think the actual return was annualized in 20 years?
I don't know. much less than
It was 5.62%, and that's before any kind of taxes. So if you'd started late in life and only and just coincidentally, because we can't time the market, only had those 20 years to go, you only got 5.62%. Far underperforming what you were hoping to do, I'm sure. Far underperforming 12%, that's for sure. So it's amazing, length of time in the market and just what time period and what events in life happened, where those downward pressures is going to create even more eroding factors and make this fallacy more prevalent, more obvious.
You only get one shot at this. And so everyone, both Brian and I today, and everyone listening, the day that you're listening, you are where you are on that growth curve. It's not that perfect mountain chart, but wherever you are on the actual compounding growth curve of your life so far, of your accumulation phase, that is where you are. You can't get any of that time back. And so hopefully you have enough years ahead to where you can make the appropriate changes. And what we try to do is help people rearrange that financial order of operations in order to take all of these factors into consideration. But never forget that even though day to day you're living your life and 20 years, 30 years, retirement, it all feels like a long way away. You only get one shot at this. And these are the foundational years where if you are going to get any advantage from compounding growth, well, that initial runway phase there is pretty long. And so if you missed out on that time, you're starting from the beginning of that curve. You're not where you might think you are on that mountain growth. So never forget, you only get one shot at this.
But guess what? We live in a world of abundance, everybody. And that's why when you're in your car, your rear view mirror is really small. And the window in front of you, seeing what's in front of you, is huge. And always think about it that way too. I mean, what's behind you is behind you, and you don't need to be always looking into the past because you'll get stuck there. So look into the future, and let's look at a world of growth. Let's grow, man.
Yeah, I want to go back to the stat we mentioned at the very beginning. It takes 100% increase to make up for a 50% market decline. And hopefully that makes more sense now. Another one that's pretty powerful is in 1 year, if you take a 50% loss in the market, it's going to take 7 years of 10% gains to get back to even. So how much do you trust the market? How much do you of your future, of your one shot at this, do you want to leave in the hands of people with conflicting incentive structures and subject to all of these forces, not only the market, but all of the other eroding factors we talk about? We, in what we do, when we are setting up IBC policies for people that work with us, we're looking for guarantees and uninterrupted positive compounding growth. We deal in certainty, not mathematically flawed speculation. If you're hearing this and you're not quite certain where you are on that projected mountain curve and you want to know what these factors might actually do, let's not look at past returns to try to project in the future and roll the dice with our one shot. Let's deal in certainty.
Yeah, and there's a place to say that even if you love the market and you want to stay in it because overall it's going to go up like we talked about, definitely not what they're projecting. There's still 100%. We can lift all these boats by having guarantees, certainty, and efficiency in our money. If you did both, it's an and asset, what we'd like to do. So we like to think in terms of constant compounding, guaranteed efficiency, collateralization, private money. So all of those things, even if you want to be in the market, while it may not be necessarily our cup of tea, it's only going to make that money stronger, better, and with less risk. Always do it from a position of strength. Let your foundation be savings, and let your savings be in the optimal environment of what we have available in America.
Yeah, so hopefully we drove home that point. And in summary, stop being a passenger in your family's financial future. Fully take back control of your wealth. We'll see you next time.
All right, see ya.